This is our Forex blog for December 11th, 2012. Most days we go over our currency meter and how to identify the strongest and weakest currencies. I'm experimenting with a lot of things right now as far as my own trading workspaces and automated systems, which I need another workspace to use. So until I resolve some of those issues, I'm just going to go over some of our best tools each day. This is our new Smart Trader window, which lets you see all the key support resistance in a tiny footprint window. If you were to put our 15-minute, 30-minute, 60-minute, 240-minute statistical high and low, as well as the one standard deviation high and low for all those periods on your regular chart, whether it's a 2-minute chart, 5-minute, or in this case 5 pips per bar range chart, you would have so many lines on there that it would just absolutely confuse you. I have the 4-hour statistical range on the tools that I trade with, because I've found that at and above the 4-hour statistical high, especially if it's at a fib target, I can kind of scale into a big position and it will usually come back my way. You can see that today and earlier today, or last night actually, went above the 4-hour high, came back right here, above the 4-hour high, came back, and a little bit later, just recently, above the 4-hour high and pulled back. It's such a high probability trade that you can pretty much make a living just trading that one pattern. So seeing where all these statistical levels reside in a very tiny footprint, in my opinion, makes trading really easy. And I actually posted one of my trades today on our Facebook blog, Facebook page, where I sold the pound dollar at 61.179 and got out pretty much close to the 6100. This was my target. Came down there and it was really kind of slow and it didn't go underneath there, but I will you can go check our Facebook page to see the time that I posted that trade live. I got short right up here. I didn't get the top tick. I was probably 3 or 4 pips off the high. But the point is, it was very close to this 4-hour statistical high at the time. It was near the upper containment band, and I believe at the time I had my fibs off of this last swing, and so I knew it was really close to the 1.618 fib target. These fib targets, especially when they're really close to my Fibonacci analysis from the night before, this gray level is what I thought was going to be the likely max high today in the pound dollar. When everything kind of comes into place like that, you can get into these wonderful trades. Now, another tool we just released yesterday is the new Keltner channel, which uses our digital signal processing technology. I've been trading with this for the last maybe month and a half, 2 months, and finally had my partner put it in our regular study. I had to create a script to do this, and he was working on a bunch of stuff for our automated systems that we trade with our own accounts. But that being said, this was very critical part of our system, and so I wanted our traders to have it too. It uses a very fast digital signal processing based center line, and you can see it's very fast. If you see a move that's up and you get a pullback to the lower band, it's a very good place to buy, as you can see right here in the pound dollar. I think I bought the pound yen earlier today, and I'll show you why. It was in an uptrend. It pulled back. Here's the hourly moving average, this really thick gray line. It was right at the previous day's high. There was major resistance there before. Lots of traders in positions here, and it's, anytime you see a nice little rectangle pattern like that for many hours, it's going to provide natural support on the way down. Combined with the fact that it was the previous day's high, previous day's value area high, and last week's weekly value area high. So there's major support here that the biggest traders in the world are likely to trade off of. I got into probably an average size position. I didn't get into a small one, and it certainly wasn't my biggest size, but I was preparing this kind of scaling all the way down to maybe 40. I thought 40 would be the lowest here, so I didn't get my full position on there, but it popped up nicely, and I made, I don't remember the exact amount, 15 to 17 pips pretty fast. And so these statistical areas, anytime you draw your fibs off of a previous swing, if you get into trades at the fib target and it happens to be at, or in this case above, the 4-hour statistical high, it's a very high probability trade. And so when you use this little smart trader window, I'm going to move it back here, it lets you see all those levels. For instance, let's take a look at the pound dollar chart. This is kind of a dead time of the day. It's up here near the highs. I wouldn't want to buy it up here near the highs. Traders that tend to buy the highs or sell the lows tend to lose money. If it pulled back, I would consider going along around 86, yesterday's value area. It's likely to be natural support. Same exact pattern with the pound yen. It acted as a nice little rectangle pattern here. If it goes up again, I'd want to sell the next fib target up, which is off this chart screen, but it's probably 61.40 or 45. So 61.45 in the pound dollar is actually above the 4-hour 1 standard deviation, so it's not likely to hit that level. During the next 4 hours, probably the maximum likely high is 61.30. So if it for some reason shot up 20 pips, this would be a relatively good place to get into a trade. And in fact, because it's tested this area so much today, the third time up, it's likely to bust through the 20 level. But earlier today, obviously, these were great areas to sell in the pound dollar. So let me just repeat. Yesterday's new version has this new Keltner channel, which is just very, very fast. It is so much faster because it uses our digital signal processing based moving average for the center line, that when you have a strong trend up, these bands are going to get hit, whereas normally a regular Keltner channel's bands are going to be lower and you're not going to have these areas to buy. Notice how you bought here, it went up, bought here, it went up, bought here, kind of went sideways for a little bit and then popped up 20 pips. It's just a very high probability tool when you use it to trade with the trend. For instance, let's take a look back at that pound yen. It exploded up, but it didn't really explode up. It kind of inched its way up. Notice this area right here is a buy. If you got into and scaled into a position here, you made money. You got into position here, you made money, and so forth. If you got into scaled into a little position here, you're up money on that one. It's just very fast. And just to give you an idea of how much faster it is than the regular one, let's put the regular Keltner channel on here with gray lines. You can see for yourself it's much slower. I'm going to put the regular one on here, and you can see that the regular Keltner channel is all the way down here at 132.83, whereas this one's up here at 93. It's 10 pips higher. You know, earlier today it was pretty close because this was kind of a gradual move up. But anytime there's an explosive move, these bands are going to react and move very fast. So when you use all of our tools in combination, along with our new Smart Trader windows, it really lets you know where to put stops. You can use these to put stops. It's very unlikely at this time of the day to go above 61.22, so it's only 12 pips away. That would be the 1 standard deviation hourly high. If you really wanted to walk away for 4 or 5 hours and have a pretty slim chance of your stop getting not hit, 61.29 would be where you'd want to put your stop. And we also have different very fast containment bands on smaller time frames like 5 minutes and 15 minutes that show you the likely reversal. They're so fast that if price happens to come down here, you might only touch these levels twice a day. It tends to move 5 to 10 pips off of it pretty rapidly. So you can use those to scalp. Let's go over the euro yen. And I mainly just want to show how you can use our tools when you see an explosive move up. Notice how the super fast Keltner channel finds the support here and it goes up. And notice where it's at. It's right above our 4-hour statistical high. It happens to be near another major resistance area. This is last week's point of control where most trading activity of the prior week happened. And so that's a major resistance area. Our signals at such an important level that we, if certain chart patterns happen around this area, we put a sell signal on the chart. And, you know, so you would, if you were buying this, you'd want to get out, flip and go short, and maybe make 15 pips on the way down. And notice, because these bands are so fast, when the price is coming down, finds support, and goes back above those Keltners, because they're so fast, you can actually go long right here with your stop right underneath the low. And one of the techniques I've always used with stock trading, and recently done it again for Forex, is, let me see the trade I got into. Yeah. If you see a previous bar, and this one's not a good example of it, but a lot of times if you're looking to buy, if price goes above halfway on the previous bar, you can go long there with your stop underneath the low. And so what that means is, typically I've been suggesting waiting for pullbacks, and then when it goes above the previous bar's high, you can go long. Let's say you wanted to buy right around here. That would mean you would buy up here at the previous bar's high. What I've found is with these new Keltner channels, if I think this is a likely low and I want to buy, I will wait for it to go above the halfway point of the previous bar, which is right here. In this instance, I'd be buying this at 132.60 with my stop right underneath here. Notice that's 4 pips plus the spread. You know, with losses that tiny, you can, for instance, let's say you trade one lot and you lose 5 pips. Well, you see another trade, you do 2 lots and you maybe make 5 pips. Well, guess what? You got your loss back plus you're at 5 pips. And a lot of times the second trade, you know, will go 10, 15, 20 pips and you have twice your normal trading size and you get your loss back plus a lot more. And then you start over with, you know, 1 lot, and then if you lose, you do 2 lots in the second one. By losing such a tiny amount, you can trade much more lots than you normally trade. You can see in this case you're in at 60 versus 64. That's 4 extra pips. Let's say you waited for it to go above that bar's high right here, and it's going up, and it's going down, it's going up, it's going down. You might at that point say, well, it's not going to work, I'm going to get out. You might lose 7 or 8 pips. Whereas if you got here into the middle at 61, you have a lot more ability to hold that position with, you know, pretty much no stress. And you can see you're risking this tiny amount right here. It goes up, you know, maybe if you were watching this real time, you might get out of there with 4 or 5 pips, comes back down, doesn't stop you out, you might go long again here, and then that one shoots up, you know, 10, 12 pips. So you had 2 trades there, made 4 pips, you made 12 pips. And that's just an illustrative purpose. Let's say you did the same exact thing down here. You think it's going to come down here, it's not going to, it's going to pop here at the band. Put your stop underneath the low. Well, guess what? You lost 4 or 5 pips. All right, no big deal. It comes back down. We have another buy signal right at this major support. This is the hourly moving average, which we all know tends to be support. You get back along, and this is, you know, kind of the trade that I took earlier. I didn't catch the full 30 pips. I only got about 15 to 17 of those. But the point is, you know, it's a very high probability place. Notice this trade right here. Pulls back. Here's, you know, kind of the halfway mark on the bar, and then you can see it acted as support. Maybe you would go long right here with your stop underneath you, you're risking 5 pips. It goes up, you make 7 or 8 pips, you're out, pulls back, finds support. I always give it every opportunity to make a lower low, and if it doesn't, then I'm, you know, okay. I'll usually 3 or 4 bars. If it can't break that low, I will look to get in again. So 1, 2, 3. I might have actually got into that trade right here again. I was actually in that pound dollar short at that time, so I didn't take this one. And I usually put my stop a few pips under the low, so I wouldn't have got stopped out here. Comes down, then shoots up. I wouldn't have expected this to keep continuing like that. I would have only made probably 12 or 13 pips. But the point is, by getting into a trade when it goes halfway above the previous bar's middle, pretty much, you can have very, very tight stops, even smaller than we've been teaching using range bars. And I found great success with it. And typically at the highs, I will scale into big positions. So what I've been doing here at buying pullbacks is kind of getting into a relatively small position. If I lose, I'll just get into a bigger position in the second trade. It's kind of like scaling in, but I would just get out and then get back in again. That way, if the trend continues down, I don't have to get back in again, and I've had a tiny loss. It saves me from taking a big hit in the middle of the range. I don't like to have huge positions in the middle of the range, but I don't mind scaling into huge positions at the statistical likely highs because I just have a tremendous success rate at doing counter trend above our statistical levels.